Right now, as we speak, a silent financial war is brewing. It's a war that doesn't involve guns or tanks, but one that could decide the fate of the global economy. For over a century, the United States has held an iron grip on global finance, with the US dollar acting as the world's reserve currency. Nations around the world have relied on US Treasury bonds as a safe and stable investment. But what happens when they start pulling out? What happens when the world begins to abandon the dollar? The answer to that question may be unfolding before our very eyes, and the consequences could be catastrophic. To understand the crisis unfolding today, we must first understand how the United States built its financial empire. After World War II, the Bretton Woods Agreement of 1944 established the US dollar as the dominant reserve currency. Countries around the world linked their economies to the dollar, which was backed by gold. This meant that nations needed dollars to conduct trade, making the US the most powerful financial entity in history. Even when the gold standard was abandoned in 1971 under President Richard Nixon, the dollar's dominance remained unchallenged. Why? Because global trade, especially oil, continued to be priced in dollars. This system, known as the petrodollar agreement, ensured that the US could print money without fear of inflation spiraling out of control. But now, the pillars holding up this system are starting to crack. For decades, foreign governments have used their trade surpluses with the US to buy US Treasury bonds, keeping their economies stable and their currencies competitive. China, Japan, India, and Saudi Arabia have all been major players in this system. But in the past few years, something unprecedented has been happening. These nations are dumping US treasuries at an alarming rate. China, once the largest holder of US debt, has cut its holdings from over $1.3 trillion in 2013 to around $767 billion today. Japan has reduced its US Treasury holdings from $1.1 trillion to under $1 trillion, the lowest in decades. India has dropped its holdings from $200 billion to $34 billion, shifting its reserves towards gold and alternative investments. Saudi Arabia and Germany have also started reducing their dependence on US debt. Why? The answer lies in the shifting global financial order. Several factors are driving this shift. Geopolitical tensions and US sanctions. Countries like China and Russia are tired of being vulnerable to US economic sanctions. By diversifying their reserves away from the dollar, they reduce Washington's leverage over their economies. The rise of alternative reserve assets. Central banks around the world are turning to gold, digital currencies, and non-dollar trade agreements to secure their financial future. The fear of a debt crisis in the US. With US national debt surpassing $34 trillion, many nations fear that Washington's financial mismanagement could lead to a dollar collapse. This isn't speculation. It's happening right now. China is leading the charge to dethrone the US dollar. And it's not just selling US treasuries. It's actively promoting its own currency, the Chinese yuan, RMB, as an alternative global reserve currency. The Belt and Road Initiative, BRI, China is offering infrastructure funding to over 150 countries using the yuan instead of the dollar. The digital yuan, ECNY, Beijing, has already rolled out a central bank digital currency, CBDC, that could bypass the US banking system entirely. Oil deals in yuan. China is pushing Saudi Arabia, Russia, and Iran to accept yuan for oil transactions, directly challenging the petrodollar system. Here's why this matters. If the world stops buying US debt, the US will be forced to print even more money to fund its government spending. This would create massive inflation, causing the dollar's value to plummet. The Federal Reserve would then be forced to raise interest rates dramatically to stabilize the economy, but that would send the stock market and housing market into freefall. It's a lose-lose situation, and Washington knows it. As the world pulls away from the US financial system, Washington is preparing to fight back. The question is, how far will the US go to protect its financial empire? Washington's aggressive economic policies have set off a chain reaction of global retaliation. Countries that once relied on the U.S. market are now forging new alliances, redirecting their economic strategies, and actively distancing themselves from American financial influence. This shift is not just a momentary disagreement, but a fundamental reordering of international trade and power dynamics. The latest tariffs imposed by Washington were meant to boost domestic production, but they have had unintended consequences. Trading partners such as China, the European Union, and India have implemented their own countermeasures, placing tariffs on American goods and restricting key exports to the U.S. These actions have fueled inflation, increased manufacturing costs, and disrupted supply chains across multiple industries. China, as the largest U.S. trading partner, has responded decisively. The Chinese government has accelerated the reduction of U.S. debt holdings, cutting its Treasury bonds by billions while investing heavily in alternative markets. In addition, China has strengthened its economic ties with Russia, the Middle East, and emerging economies in Africa and Latin America, creating new trade agreements that bypass the U.S. dollar altogether. The European Union has also taken significant steps to insulate itself from American economic influence. France and Germany, the two largest economies in Europe, have called for greater financial independence from the U.S. They are now working on increasing trade within the Eurozone and deepening their partnerships with China and India. Meanwhile, the European Central Bank is exploring ways to decrease reliance on the U.S. dollar in global transactions. Russia, already under heavy economic sanctions, has shifted its financial strategy towards self-sufficiency and collaboration with non-Western nations. The Russian government has increased its use of the Chinese yuan, strengthened its oil trade with India and China, and continued efforts to build an alternative global financial network that circumvents the US-dominated SWIFT payment system. India, a rapidly growing economy, has taken a dual approach. On one hand, it maintains trade relations with the US, but on the other, it is actively diversifying its foreign exchange reserves. The Reserve Bank of India has significantly increased its gold holdings and reduced its dependency on US dollar-based assets. India has also engaged in currency swap agreements with Russia and the United Arab Emirates, allowing trade to occur in local currencies rather than in dollars. The Middle East, particularly Saudi Arabia and the Gulf states, has made a historic move by considering oil transactions in multiple currencies, including the Chinese yuan and the euro. This shift poses a direct challenge to the petrodollar system, which has been a cornerstone of U.S. financial dominance since the 1970s. If these changes continue, the demand for U.S. dollars in global energy markets could see a sharp decline. This wave of global retaliation is not just limited to governmental policies. Large multinational corporations, sensing instability in the American market, are also hedging their bets. Many are expanding their operations outside the U.S., investing in manufacturing and logistics hubs in Southeast Asia, Latin America, and Africa to avoid potential tariff risks. As these global shifts intensify, Washington is faced with a difficult choice. The U.S. government must decide whether to double down on protectionist policies or seek diplomatic solutions to restore economic stability. The coming months will be critical in determining whether the U.S. can maintain its financial leadership or if it will witness an irreversible decline in its economic influence. The question now is, how will Washington respond? With economic alliances shifting and trust in the U.S. dollar eroding, the world is watching to see whether American policymakers can adapt to the new global landscape, or whether they will push forward with more aggressive policies that could accelerate their own financial downfall. The U.S. financial system is at a breaking point. The cracks that have formed over the last decade are no longer hidden beneath the surface. They are now fully exposed, threatening to bring down the very foundation of America's economic dominance. For decades, Washington relied on the strength of the dollar and the global demand for U.S. debt to sustain its financial empire. But now, that system is unraveling, and the consequences could be irreversible. The shift away from U.S. treasuries is accelerating. Countries that once viewed American debt as the safest investment in the world are now offloading their holdings. At an alarming rate, China, Japan, and several major economies have drastically reduced their US bond purchases, no longer willing to finance Washington's massive deficits. The Federal Reserve is struggling to contain the fallout, attempting to stabilize markets with interest rate adjustments and monetary policy maneuvers. But the problem runs deeper than short-term fixes can resolve. Trust in the dollar is eroding. The world no longer sees the US financial system as the pillar of stability it once was. Rising debt levels, inflation concerns, and reckless fiscal policies have weakened global confidence. Nations are now aggressively seeking alternatives, building new trade alliances, and shifting their reserves into gold, digital currencies, and bilateral currency agreements that bypass the dollar entirely. The structure that held the global financial system together for decades is being dismantled piece by piece. Inside Washington, panic is setting in. The government faces a difficult reality. Without foreign demand for US debt, it will have to print even more money to sustain its obligations. This creates a dangerous feedback loop where inflation spirals out of control, the cost of borrowing skyrockets, and the economy descends into chaos. Federal Reserve officials, Treasury analysts, and political leaders are engaged in emergency discussions, scrambling to find a way to restore confidence before it's too late. Efforts to contain the crisis are becoming more desperate. The US has begun pressuring its closest allies to maintain their Treasury holdings, using diplomatic leverage to slow the exodus from American debt. But even longtime economic partners are hesitating. Countries that were once firmly in Washington's corner are now reconsidering their financial commitments. European nations, once deeply tied to the US monetary system, are hedging their bets. Even Japan, traditionally the largest foreign holder of US bonds, is gradually shifting its strategy, recognizing that long-term exposure to US debt could become a liability. At the same time, America's adversaries are accelerating their efforts to replace the dollar. China and Russia are deepening their financial cooperation, expanding their use of local currencies for trade and investment. The global push to move away from SWIFT, the dollar-based financial transaction system, is gaining momentum. Countries under US sanctions have developed alternative mechanisms that allow them to operate outside of Washington's control. These moves, once dismissed as symbolic gestures, are now becoming a genuine threat to the US financial system. The implications for the average American are severe. If the dollar loses its global reserve status, the effects will be felt by households across the country. The cost of imports will rise sharply, inflation will accelerate, and interest rates will spike, making it more expensive to buy a home, finance a car, or even secure basic necessities. The days of cheap credit and unlimited government spending could come to an abrupt end, forcing a level of economic austerity the US has not seen in generations. The government's options are narrowing. If Washington fails to restore global confidence in the dollar, it could face an economic crisis unlike anything in modern history. The stakes have never been higher. As foreign nations move further away from US treasuries, America stands at a crossroads. Either policymakers take radical steps to prevent a full-scale collapse, or the world moves ahead without the dollar at its center. The question remains, does the US have a plan to stop this from spiraling out of control, or is it already too late? Washington's response is swift, calculated, and desperate. The cracks in the US financial empire have widened, but policymakers refuse to accept defeat. The Federal Reserve, the White House, and major financial institutions are now operating in full crisis mode, scrambling to prevent the final collapse of dollar dominance. What follows is an aggressive set of measures designed to reassert control, but the world is no longer playing by America's rules. The first move comes from the Federal Reserve, which implements a series of emergency interest rate hikes to stabilize the dollar. The idea is simple: make the dollar more attractive by increasing returns for investors holding US assets. But this tactic comes with consequences. Higher interest rates lead to tighter credit markets, making borrowing more expensive for businesses and individuals. Economic activity slows, corporations cut jobs, and consumer spending declines. The stock market reacts violently, with historic volatility, as investors attempt to interpret whether the aggressive rate hikes will restore confidence or push the economy into recession. Washington's next move is diplomatic. Senior U.S. officials are sent on a global tour, meeting with allies and financial leaders to reassure them that the dollar remains the safest and most stable currency in the world. They offer incentives to nations considering abandoning the dollar, including favorable trade agreements, security guarantees, and access to exclusive investment opportunities. Behind the scenes, leverage is applied. Countries that have begun reducing their U.S. Treasury holdings face quiet warnings of economic consequences. Some allies comply, understanding the risks of angering Washington. Others resist, continuing their path toward financial independence. As Washington pressures its allies, a more aggressive campaign is launched against adversarial nations that have accelerated their shift away from the dollar. Sanctions are expanded. Banks that facilitate trade in non-dollar currencies face severe penalties, their access to U.S. financial networks restricted. The SWIFT global payment system, still largely under American influence, is weaponized against those who refuse to comply. Several foreign financial institutions are blacklisted, causing turmoil in their economies. The message is clear: abandon the dollar and you will face economic warfare. Despite these aggressive measures, some nations double down on their efforts to move beyond U.S. financial control. China and Russia respond to sanctions by deepening their financial alliance. They establish alternative payment systems, bypassing SWIFT entirely. They push for greater adoption of the Chinese yuan and Russian ruble in global trade. Bilateral agreements between these nations and key economic players like India, Saudi Arabia, and Brazil grow stronger. Europe, long aligned with the U.S., faces internal divisions as some nations begin questioning whether remaining tied to Washington's financial dominance is in their best interest. Corporate America finds itself caught in the middle of this financial war. Large multinational corporations, which have historically relied on global trade, now face pressure from Washington to align with U.S. policies. Some companies comply, reinforcing their commitment to the dollar-based system. Others, however, begin quietly diversifying their operations, investing in markets that are shifting toward non-dollar trade agreements. Supply chains are reorganized, investments in foreign assets increase, and contingency plans are developed for a world where the U.S. dollar is no longer the undisputed reserve currency. The U.S. government, realizing that traditional measures may not be enough, takes a historic step toward securing the dollar's future. A major push is made to accelerate the development and implementation of a central bank digital currency. The idea is to create a fully digital dollar integrated into global financial systems in a way that maintains U.S. dominance. This initiative is met with mixed reactions. Some investors see it as an innovative way to modernize financial systems and strengthen the dollar's role. Others view it as a desperate move, a sign that Washington knows it is losing its grip on global finance. As the world watches, the final battleground takes shape. The fate of the dollar, and by extension, America's economic power, depends on whether Washington can outmaneuver the rising economic bloc that seeks to replace it. If Washington's strategy succeeds, the financial order remains intact and the dollar retains its supremacy. If it fails, the world will witness a seismic shift in economic power, one that will redefine global finance for generations. The clock is ticking, and the outcome remains uncertain. Washington has fought back with everything it has, but the question remains: is it too late to stop the decline, or has the world already moved on? The global financial landscape has shifted irreversibly. The battle over U.S. economic dominance has reached a critical juncture, and Washington's attempts to maintain control have yielded mixed results. Despite aggressive interest rate hikes, diplomatic pressure, and economic sanctions, the world is no longer as reliant on the U.S. dollar as it once was. The cracks in America's financial empire are no longer just forming, they are widening at an alarming pace. Nations that once unquestioningly held U.S. Treasury bonds have diversified their reserves, opting for gold, digital currencies, and regional trade agreements that bypass the dollar entirely. The financial war has now entered a new phase, one where the U.S. is no longer the undisputed leader, but a competitor in an evolving multipolar economic system. The response from Washington, though calculated and aggressive, has only partially slowed the momentum of this global realignment. For the American people, the impact of this financial shift is becoming tangible. Inflation remains high, interest rates are volatile, and the cost of living continues to rise. The stock market swings between brief recoveries and sharp declines, reflecting uncertainty about whether Washington's strategies will work in the long term. Meanwhile, foreign economies that once depended on American financial institutions are forging new paths, making it increasingly difficult for the U.S. to dictate global monetary policy. Yet, amidst the uncertainty, one question remains unanswered. Will the U.S. adapt to this new financial reality, or will it continue fighting a losing battle to preserve its former dominance? The possibility of a global economy no longer centered around the dollar is no longer a distant theory. It is now a real and present challenge. While Washington has taken drastic measures to slow the decline, it has not been able to stop it completely. The world is watching closely. Economists debate whether the U.S. will be forced into a long period of economic contraction, or if policymakers will find a way to reinvent the financial system in America's favor. The introduction of a central bank, digital currency, may be a step in that direction, but it is met with skepticism. Some see it as a necessary evolution of the financial system, while others view it as a desperate attempt to retain control over an economic order that is slipping away. Geopolitical tensions remain high as Washington seeks to maintain its alliances and prevent adversaries from gaining too much ground. The future of the global financial system is now a battleground, where decisions made in Beijing, Moscow, and Brussels carry just as much weight as those made in Washington. The U.S. can no longer afford to assume that it holds the final say in economic affairs. As this financial war unfolds, the question is no longer whether the world is moving away from U.S. economic dominance. It is how fast. The response from Washington in the coming years will determine whether the U.S. can remain a central player in the global economy, or if it will be forced to take a back seat to emerging financial powers. The world is changing, and the U.S. must decide whether to fight against that change or find a way to lead within it. What do you think? Is Washington's response enough to prevent a full-scale collapse of U.S. financial influence, or are we witnessing the beginning of a permanent decline? The future of the global economy depends on the answer.